Please join me in welcoming Mr. Chris Nance.
Thank you, Mary Lou. Okay, let me say, I'm not here to sell you anything. I'm going to talk with you about how earthquake insurance works. But we're also going to talk about the risk a little bit too. And surely you all know a lot about the risk already. So some of this is you're going to already know about. Perhaps I can add a little seasoning to what you already know. So we got to start with, it could happen today. You already know that, right? So we're not sharing any secrets. And you already know this, but you know, within the state of California, about 80% of the population lives very near an active earthquake fault. Statewide, most Californians live within 30 miles of an active fault. For you all, it's much closer. And you already know this, 99% chance of a magnitude 6.7. We say that because that was the size of the Northridge earthquake, or larger sometime in the next 30 years. I've been saying that for 10 years. I'm getting kind of tired of it, but I hope it never happens, and surely you all think the same. Now here in Southern California, a 75% chance of a magnitude 7.0. How many of you knew that simply going from a 6.7 to a 7.0 is 3 times the energy, 3 times more energy than a 6.7? That's kind of frightening, a 75% chance somewhere here in Southern California. All right, here are faults that surround you. A couple of things. Now, you already know about a lot of these faults, for sure. We invest mightily in earthquake science. It's part of our business. Our business model depends on the latest, greatest earthquake science. And as recently as 10 years ago, now earthquakes move in geologic time, you know, centuries in time. As recently as just 10 years ago, scientists were looking at simulations on a fault. And they had a few scenarios to look at. 10 years later now, what they've come to conclude is that what they previously thought about earthquakes and their respective ruptures being contained to a single fault, now what they know, based on earthquakes elsewhere around the world, that earthquakes are a part of a system, a fault system. So a rupture on a fault in a system could potentially trigger a rupture elsewhere in that system. So for those of us at the CEA, we've had to change to accommodate that science. We're required by law to honor the best available science. So when you look at where you're located here with the blue star, you can practically reach out and touch the San Andreas Fault. But that fault's part of a fault system. But let's talk about San Andreas. There's a guy that Dennis and I know very well, who's now retired, but a gentleman named Dr. Tom Jordan, who led the earthquake science, the Southern California Earthquake Center at USC. He spoke at a national earthquake conference a couple of years ago. Reporter Ron Lynn with the LA Times was there. I'll never forget Dr. Jordan stepping up in front of a big crowd like this to say, that Southern San Andreas, it's locked, loaded, and ready to roll. So you might think, well, what the heck does that mean for me? And one of the things, well, we're learning a lot every day. In fact, just today, talking with you all, I've already learned a lot. Most people think earthquakes won't happen to them. Dr. Dennis Milletti will confirm that. People who sell insurance for any type of peril will tell you, most people think it won't happen to them. If there's an earthquake in this area, maybe I have a little damage, but the people who are really messed up, I'm going to see them on the news. It's not going to happen to me. Maybe you might think a little bit differently after you see this USGS simulation. So that's what Dr. Tom Jordan is talking about as being locked, loaded, and ready to roll. How many of you have seen this simulation before? A few of you? Good for you. That's good. So for those of you who've read more about what you see here, you know it's not just the red area to be concerned about. This entire region is going to be shaken very badly. And for those of us at the CEA, we differentiate between shaking and strong shaking. The word strong correlates with potential damage. So we're going to talk more about what that looks like for us. Okay, so there's a lot of type here, and I apologize for that. But it's a challenge for us because we have so much we want to share. We have so little time to talk about it. 3.5 million homes built before 1980 are going to feel shaking strong enough to cause damage. We say built before 1980 because that's before building codes were in place throughout the state to help mitigate earthquake damage. About 50% of our policyholders that felt strong shaking, we expect to file claims. 50% of them. And based on all the modeling that we do, we think that that will add up to about, we don't think, we're pretty confident, because we're required by independent rating agencies and the Department of Insurance to demonstrate our ability to pay claims. We're required to do that by law. All our modeling says $6.2 billion. And that's for the people who have policies. That's about a third of our total claim paying capacity. We'll talk about that more in a moment. So I always, as a member of our executive team at the CEA, I'm never satisfied with the number 6.2 billion, because for me, to be helpful to you, I don't know what to do with that number. And we're still experimenting with this. And frankly, so far what we're learning is that people are kind of balking at this because they don't know what to do with this information, but I'm going to share it with you anyway. So you can tell me if it's confusing, and I'll appreciate hearing that. But through all of our modeling, now what home insurance agents will tell you is what they're insuring is the cost to rebuild. Very different from the appraised value. The cost to rebuild varies by region, but not like the appraised value. The appraised value is location, 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 right? The insured value is if your house burns down, what will it cost to rebuild? We are required by law to match that home insurance policy. So thanks to Dennis, I worked with a couple of zip codes in your area. So I'm just giving you an example of what we see. Now this is just, again, it's an example. It's not precisely this. It can be more, it can be less. A newer house, so that's in the 2000s, insured, not appraised for reasons I just mentioned, for $770,000, could suffer more than $90,000 in structural damage. Now that's a house built to code. It's designed not to fall down during an earthquake. But building codes aren't designed to eliminate damage. You're still going to have damage. You just reduce it by having construction according to current codes. Simply said, that's bracing the house to the foundation. If you're on a raised foundation, you're shearing the inside of that, what's called a cripple wall. If you step up into your house and you're in an older house, we'll talk about that more in a minute too. But a big difference. Look at the pre-1940, insured for less, $505,000, more than $140,000 in structural damage. I will tell you, this is the first time we've ever talked about numbers like this with folks outside our own office. Do you find this helpful? What if you also knew if you retrofitted that house by doing what we just talked about, you could reduce that damage by about $47,000. That's real money. So here's the kind of house we're talking about, an older house. So typically if you step up a few steps into the house, it's on a raised foundation. That area between the ground and the first floor, we call that the cripple wall. And you can see how the house is rocked off the foundation because when the ground's shaking, that wall's not designed to sustain it. So here's what the retrofitting looks like. To simply affix the plywood inside, now this is according to code, and to brace and to bolt the house to the foundation, a few $1,000 to do that, to save potentially $47,000 or more. Seems like money well spent to me. You all can be the judge of that. But if you're in an older house, built before those building codes were in place, if you're stepping up into the house in particular, and you don't have this shearing and bolting in place, we call it bracing and bolting, we recommend you talk to somebody about getting that done. For reasons now, hopefully you have a better understanding why. All right, so this is something that we need to be talking about more. Our CEO is a former insurance commissioner from the state of North Dakota, and at that time they had the Red River flood. He tells stories all the time about in North Dakota, everybody knows everybody. And some of his best friends, well-educated, professors, doctors, contractors, people who are calm, predictable. After that earthquake, their eyes get this big around. They can't think anymore. Some of the smartest people he could say he knew back then. Everything changes, and so it comes time to figure out what the heck to do, and you're just snowblind. So you contact your residential insurer if you have a claim, if you have a policy. Now with the CEA, something that's new, we'll write you a check right away for $1,500 for emergency repairs. I was talking in LA a year or so ago, and I learned about this. I was introduced to a gentleman whose first day in California after moving to Chicago was in a hotel the night of the Northridge earthquake. And he was shaken awake, and he watched the ceiling split open. $1,500 gets you a tarp. Like that. Especially if it's during winter time, could come in handy. Helps you get the broken glass out of the carpet. Loss of use never has a deductible. How much do you think it will cost to live out of your home for a month, 2 months, 3 months? No deductible there. Now, if you're like me, you're going to see a mess and you're going to want to clean it up. Don't do that. Take pictures. Pictures will support your claim. We train the adjusters who come from your home insurance companies. They know what they're doing. Pictures help. And then, of course, this sounds simple. Keep all those names, numbers, receipts. It's going to come in handy. When you're wide-eyed, freaked out about the unimaginable that you thought couldn't happen, and now all of a sudden it's for you to deal with, recalling this simple stuff might come in handy. All right, so how does earthquake insurance work? By the way, I had that computer in graduate school. And to write a 10-page paper, you'd have to pull out one disk after 5 pages and finish it on a second disk. Thankfully, we're not working like that anymore. But the legislature back then said to home insurance companies, if you're going to sell home insurance, you have to offer earthquake. We get asked all the time, why isn't earthquake insurance mandatory? Well, this was a decision by the legislature that we honor. What is mandatory is, if you sell home insurance, you have to offer earthquake. Then along came Northridge, and the game changed. These earthquakes, fortunately, are few and far between. But when they strike, they leave memories that last a lifetime, and effects of numerous reasons alongside. In this case, those home insurance companies that were offering earthquake also were covering the exposure. I told you a little bit earlier about what we've learned just in the last 10 years. This goes back to 1994. They had no idea what was at stake, how much that damage could cost. $20 billion to residential damage alone. By the way, little factoid, half those folks were insured. Today, half the people who were insured then are insured now. And the total damage for Northridge could be quadruple today what it was then, just in dollars. There are more people, more buildings. When we talk about displaced 22,000 people, We've changed the word displaced from what they reported as homeless. Homeless has a different meaning now. But what this means is 22,000 people had nowhere to go. No family, not a hotel. They were just out in the cold. The numbers are astronomical today. But for sake of this conversation, those home insurance companies that were carrying that exposure then said to the legislature, we're done. We're going to cover it this time, but this is not our business. And the legislature said, well, it's unlawful to not offer earthquake insurance. How many of you remember that? So if you were buying a home, you couldn't get a home insurance policy. You couldn't close on escrow. So the legislature, the company said, fine, we're going to stop selling home insurance. So the solution was us, the California Earthquake Authority, created then to enable those home insurance companies to offer a CEA policy, in doing so, contain to the penny their exposure. They brought dollars to make that happen. $700 million in seed capital came from the insurance companies who chose to offer the CEA policy instead of covering the exposure themselves. We have board members, including the governor, insurance commissioner, and treasurer. They're voting members. We meet with them 4 times a year. Have yet to have the governor show up at one of our meetings, but the treasurer and the insurance commissioner show up frequently. If it's not them, they have designees. We have about 100 or over 1 million policyholders now. We're focused first on education, which is why we're here. Mitigation, we talked about that a little bit already, more to come, and insurance. Here are the companies that now choose to offer the CEA policy. They represent about 70% of the total home insurance market. So if you have your home insurance with one of these companies, you're getting that notice from them that says, if you want earthquake insurance, here's CEA. We don't care if you get it from us. We want to make sure you understand what's going on here and make the decision yourself. They're offering the CEA policy. If you're not with one of these companies, you can get it from the company where you have your home insurance, or they may have another, we call it a monoline carrier that carries only earthquake insurance. We think that's great. Okay, so let's talk about where we are today. Northridge reoccurring today. $7.5 billion of CEA's, $16 billion in claim paying capacity is what we would expect to pay. 2.6 million houses, especially vulnerable to shake damage. So again, numbers for you to be thinking about. Insured for 532,000, more than 67,000. Again, this is just modeling. Some of these homes will be totally leveled, some will have a lot less damage, but these are just numbers for you to be thinking about. But when you're into an older house, less in insured value, look at the difference in structural damage. Now remember, these numbers don't include personal belongings, they don't include loss of use, they don't include any of the other insurance benefits. That's just in structural damage. And in this case, the older house could be reduced by about $120,000 with retrofitting, a few $1,000. Now, if that's for a house that's on level ground, the cripple walls not more than 4 feet. So if you're in a house on a hill, for example, that retrofitting could be more expensive because you have to engage a structural engineer to help you with that. Okay, so we get asked all the time. You know, I read in the paper about this earthquake, and it said $1 bazillion in damage. You guys will never have enough money. Well, that's not how it works. It's partially why we're here. So if you have a policy with the CEA, you have a better understanding about the fact that we're complying with state law, we're satisfying the needs of independent rating agencies and our regulator. This tower simplifies how we spend our money. So it's $17.6 billion. That's at the end of this year. So we're sitting on about $6 billion in cash. We invest that in government securities. It's instantly liquid. Most importantly, legislators can't touch it. They drool for this every year. They can't touch it. That's policyholder money to pay their claims. We spend about $360 million a year, that's a year, to buy reinsurance. That's insurance for your insurance. And then up at the top, the companies that offer the CEA policy, they're on the hook too. So the way this works is we have a big earthquake, we burn from the bottom up. So Loma Prieta, $1.3 billion cash, no problem. Northridge, $7.5 billion, practically could pay for with cash. The reoccurrence of the San Francisco earthquake, $11.5 billion, again, not a problem for us. We don't worry about whether we can pay claims. We worry about the people we can't help. The people who may have that excuse in their head that Dennis talks about all the time. It's not going to happen to me. Hopefully you're right. We hope you're right. But if you're not, then what? So this is how it shakes out statewide. 14 million households, about 10% insured. You know, in New Zealand, how many are familiar with the Christchurch earthquake? Every single person in Christchurch has earthquake insurance. When we were there after the first shake, the mayor was introducing the CEA, and the mayor said, "Did you know that just 10% of the people in California have earthquake insurance?" There was just this gasp in the room. People just couldn't imagine. All right, so for those who don't have earthquake insurance, for Northridge, it was half the people. $4 billion borrowed from the SBA. Now, the SBA says Small Business Administration, but again, remember, if you're unlucky and it's you, and you're wide-eyed and you're trying to figure out what to do, just because it says Small Business Administration doesn't mean they can't help homeowners. They offer, for the most part, below market interest, but that's got to be repaid. I'll tell you another LA story. I'm riding along in an Uber car out to the airport, and guys being very friendly. "What do you do?" "Earthquakes." "Oh, really?" I didn't say another word. He told me all about his house that was damaged, and he's still paying the loan. That was just a few years ago. $4 billion. So this gives you a sense for how these earthquakes differ. 41 million is all for Napa. That was a moderate earthquake. Loma Prieta did not hit residences hard. That was, I remember the visuals on TV. That was infrastructure, but again, a dramatic difference. So when the residential hit is high, the cost to rebuild correlates, hence the high number in dollars borrowed. All right, so Mary Lou talked about my White House experience. I remember flying into the Southeast. We were on Air Force 2, and we were talking about, this is just how you talk when you're inside the bubble, you know. We're going to drop off a sack of money for people affected by the hurricane. That was half my life ago. Frankly, I didn't know what the hell they were talking about. You know, I was there to help reporters, but I just didn't know how the money worked. But we hear all the time, "Oh yeah, the government's going to help. They're going to fly over in a black helicopter, and a sack of money is going to flop into the back of my yard, or my backyard, and I'm magically going to have enough to rebuild this chaos." So I talked about the loans being repaid. How many of you know, let me ask, guess what the average grant was for Northridge? One hand. Mary Lou, you're closest. What do you think? Yeah, for assistance. $1,500. The average grant for Napa got a lot bigger, $2,670. So that's where government's going to be. They're not designed to do this. They'll tell you the same thing. They're there to help with infrastructure, public buildings, keep the economy moving. Frankly, it's your responsibility, as they see it, to deal with your own private property. We hear all the time that earthquake's covered by their home insurance policy. For those of you in the room who are home insurance agents, we know you spend a lot of time talking about that. This is the most important information we hear from consumers that they want to know. And you'd be surprised how many people are confused by that. Same with flood. Okay, so I heard about this a lot. We also hear, it's that darn deductible. It's too expensive. Well, depending on the age of your house, where it's located, if you can throw a nickel from your front porch out onto the San Andreas Fault, chances are you're in a high-risk area, and so your rates are going to correlate with the level of risk. But what we're finding when we talk about this now is that most people are unaware about how we've lowered rates and how we've expanded choices. So what that means is we're trying to keep up the best we can by reducing expenses. That reinsurance I talked about, we've found innovative ways to reduce expenses there that we pass entirely on to policyholders. So I would encourage you to go to the CEA calculator at earthquakeauthority.com, not because I'm trying to sell you a policy, but enable you yourself to know that you've run the traps, that you have a better understanding how this works, and you make a decision that's right for you. And if that decision's to roll the dice, and that's a decision you're comfortable with, then, you know, at least you've done the homework. It'll take you 5 minutes. Have your home insurance policy with you because you need to have that home insured value. Oftentimes when people say, oh yeah, my appraised value is blah, 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 well, of course your premium's going to be higher, especially if you live in Beverly Hills. All right, so how many of you have been in a house for 20 years? So since we've been around, the cost to rebuild has gone up 170%. Now, through the reduction of expenses, we've brought down rates during that period of time a combined 55%. If we weren't reducing those costs, for sure, earthquake insurance would be too expensive. We're doing our best there. Moreover, here's where the choices come into play. The mini policy in the middle column, that's what the legislature said you have to offer. So $5,000 for personal property coverage, might have a set of dishes worth more than that. Or an armoire. Clearly, that's not cutting it in today's world. The deductible, only 15%. By the way, we still see a lot of the 15% deductibles. We worry that people are just going along with where it was way back when and are not aware of how they can make adjustments. They may want more coverage. What if you have more equity and you want more coverage? Or you're into a new house, or you're a first-time home buyer, and you want less coverage, but you prefer a 25% deductible over a 100% deductible. These deductibles are an affordability tool. We can't give away this coverage. It's prohibited by law. We have to charge you for your risk based on where you live. All the criteria around your house is factored into that. What I didn't mention about that claim-paying tower, as we call it, we are required by law, by rating agencies, to demonstrate that we can pay claims for any number of events that might happen in 1 year within a 400-year period of time. 400 years. So if we had a lower deductible, premium would go higher. So we have to figure out how to straddle that line that enables you to have access to this coverage, make the choices that work for you. Now, we also hear all the time that people think that you have to cut a check to get coverage. That's not how it works. So let me give you an example. My cost to rebuild is $400,000. So let's say it's rocked off the foundation. So do the math. If I have a 5% deductible, $20,000, CEA writes me a check for $380,000. If the adjuster says I have 105% damage, then the CEA writes me a check up to that coverage limit, $400,000. when we talk with people about that, we can just see folks say, oh my God, I had no idea. So, your agents can help you with that. You got to have the conversation with your agents. We're not authorized to counsel you on that. That's between you and your agent. But have the conversation. The loss of use, up to $100,000 now, and the mitigation discount, beginning July 1, up to 25%. So again, do the math on your premium. You put in a few $1,000s if that's what it is. It could be more. But you reduce the premium by 25%. You reduce the damage by another several $1,000s. Helps you sleep better at night. So if you go to earthquakeauthority.com, and again, check around, because you may find from other earthquake providers that it's a better deal. That's, we do the best we can, but we want to help you understand how this works. So you'll land on a page that looks like this for the premium calculator. You click on whether you're a homeowner, renter, condo, or mobile homeowner, and then we need to know your address. Okay, here's where you start to get stuff that really helps. This is the first time we've done this, looking at a newer house and an older house. So these zip codes should look familiar: 92270, 92264. The newer house, built on a slab, in that zip code, that's the average insured value. I didn't make that up. Likewise, in the other zip code, I tried to find insured values that were similar. One story. All right, so you got a little ruler there. Remember, you have your home insurance policy there. Your agent can help you with this, but you'll see that cost to rebuild. That's what drives how this works, along with your address. And you can just move that rule back and forth. So you can see, here we are with the San Andreas a few blocks away for the newer house compared to the older house. So now you know a little bit more about what's at stake. You move to the Cadillac, the 5%. Here you are. You can see the differences. Or you say to yourself, I'm okay self-insuring a little bit, but I don't want to be on the hook for the big deal. That's just beyond my imagination. So you go to the 25% deductible. See, so the earthquake insurance premium is your choice. You determine the price you want to pay. We can't give it away. Hopefully everybody understands that. And now you have a better understanding for what goes into how we derive those numbers. Remember, we're a one-of-a-kind entity. There's no other entity like us on the planet. We advise foreign countries on how to deal with this earthquake risk. So let me ask you, does that seem like it's expensive, $656, or you have a house that's more vulnerable to earthquake damage? You don't have to answer, but in your head, you know the answer. So we do about 100 of these talks a year throughout the state. And I love doing this more than anything else in my job, because we get to talk with folks and learn firsthand what's on your mind. It's helping because you're hearing from us too, and policy sales are moving up astronomically. So hopefully this is helpful. Lucy Jones, Dennis, and I have been working together very closely for a decade in time. Lucy has coined it best. What she'll say is, earthquakes are inevitable. The disaster is not. Your Preparedness Commission is, I will say, and I'm not just saying this because I'm here and I'm a rock band and I say, I love you, Rancho Mirage. I'm hearing what you're doing and the commitment you have to the preparedness. That's awesome. You're to be commended for that. Remember, there are three parts to this story. There's prepare, there's survive, and then there's recover. So in a town where half the houses are knocked down, what happens next? That's, only you can answer that.